Hi everyone, Colin here again. Today I'll share with you what are the instruments that you can use if you feel that the market is going down. How do you benefit? What do you do when you know that the market is going down? Instruments that you can use. Okay, so first thing first, when you want to do that, you are basically shorting the market. Okay, so when you're shorting the market, then what are the instruments that you can use? Okay, the first thing you can use when you want to short the market is you can use CFDs. Okay, look for CFDs. Go and look for index. Okay, look for index, whether S&P 500 index or the S&P or the Nasdaq index, and then from there you can find the index to short them. Okay, you sell them first. Okay, there are things like contract size. Okay, so make sure that you know what is the contract size and also the margin amount over there. Okay, just give you an example. Let's say right now we have a Nasdaq over here. This is a CMC market. So the margin amount is 5%. So you need to put up 5% in terms of margin. And over here, you can short it. Okay, so you can sell it first. And minimum distance basically is a spread. What is the spread over here? And what is the contract size? So basically right now, there is 1:1. So the spread is two points. The spread is 2 points, and then right now it's trading at 19,000. So basically, what it means is you have 19,000 multiplied by 5%. That is the margin that you need to put aside for this contract, 1:1. Okay, so that is for Nasdaq. Okay, so repeat again. If let's say right now you're bearish on Nasdaq, you can sell it. Okay. 19,463, you sell it. You just need to put in your account 5% of this amount and sell it. Okay, and then you will have a contract, short contract on Nasdaq. Okay, and if the price goes down, let's say from 19,000 to let's say 19,400 to 18,400, 1,000 points down, then you will basically make $1,000 lah. So that is for Nasdaq or index CFD. Okay, so next, what you can do, you can also use this instrument called inverse ETF. Okay, inverse ETF. So when you go to let's say you go to this ETF database. Okay, ETF database, you can see over here you search under short ETF or inverse ETF. So basically what they do is they will give you opposite returns for a single day, and they have one times, that means 1 time leverage, 2 time leverage, or 3 time leverage in terms of the shorting leverage amount. Okay, so over here there's a whole database over here. Like example, when you have ultra short. Okay, usually ultra short, what it means is like 3 times. That means 3 times down. If the market goes up, then we'll go down, leverage it 3 times, and negative because it's inverse. Okay, so this is inverse ETF, and basically what you do, you have offer 3 times short leverage on the index CFD on the Nasdaq index. And this is when you have short-term outlook of the market. Just remember that for shorting is always short-term. Okay, so how I will select, basically when I go into here, a short ETF, I will look for the one that is the biggest market cap because I need liquidity. Okay, I need liquidity to get in and out. Okay, so over here, enough liquidity to get in and out. Right now it's selling at $8.30, and if the market goes down, if Nasdaq goes down, then this will go up in value. Okay, so that is for inverse ETF. You can use similarly. You can use for S&P 500. You click clean again. You can see that this is also a 3 time. This 1 time leverage, not ultra. Usually ultra means 3 time leverage. No ultra means no 3 time leverage. So this 1 time leverage. And basically, again, it's inverse relationship. Okay, I believe there is also ultra short S&P 500 also. So yeah, there will be ultra here, ultra short S&P 500. So that will be again leverage 3 times. So you can actually buy this ETF. Okay, buy this inverse ETF, and you have the negative correlation with the market. If the market is going down, then this will be going up. Okay, so that will be for inverse ETF. And then besides that, okay, there are many other instruments. You can use futures, okay, you can use, in Singapore, you can use warrants, okay, to actually short the market. But I won't go into details. So things to take note when you are shorting. Number one, shorting is always a speculative position. Okay, speculative means to say you're not going to hold for long term. The market don't go down for long term. Okay, that's the first thing you need to know. Second thing you need to know is the loss is unlimited. Why? Because when market goes down, maximum it goes down is zero. Okay, that's the maximum amount you can lose. But when you short the market, and it goes up, move against you, the upwards movement is unlimited. So when you do a short position and you don't cut loss, your loss is unlimited because it can keep going up and up and up and up and up. Okay, so know that you must have a stop loss. Okay, and thirdly, I would say how to choose the instrument is really what you are more comfortable with. Okay, for index CFD, because it's margin, okay, margin, so you may have margin call. If you don't have enough margin, I won't go into detail how to calculate margin call, but you may have a situation of margin call if the position move against you, but it's highly leveraged. So let's say example is 5%, you're actually doing 20 times leverage. Okay, inverse ETF, the worst case is go to zero, okay, because you buy ETF, you cannot short the ETF, you buy the ETF, worst case it goes to zero. That's for inverse ETF, but also have a risk over there. It's just like any ETF, I can go up or down. Okay, future and warrants usually also has financing charges, so again it's more risky, okay, because there is a date to expiry, so your contract may be worthless after that also. Okay, so okay, one more thing, you can also use options to short the market also. So I hope I've given you some very quick one summary of what you can do to look at the instruments for shorting the market. Okay, I hope this video has been useful for you.